Okay, so hope you can see the presentation. And over to you. Okay, thank you, Brother Carlo.
You're most welcome, sister. Okay. So then for the outline topic for today is the need for accountability to understand the balance sheet, income statements, statements of cash flows, uses of information, qualities of financial reports, and accounting principles. And then from a biblical perspective, we have from Luke chapter 16, verses 1 to 2. Jesus told his disciples, there was a rich man whose manager was accused of wasting his possessions. So he called him in and asked him, what is this I hear about you? Give an account of your management, because you cannot be can be manager by any longer. Okay, next. So we are going to be to understand the why we need why there is a need for accountability, because it arises out of the fact that in most organizations, managers of resources are separate from the owners of those resources. And I think also we experience it in our institutes, our congregations, even some parishes, pastoral centers. Yes. Therefore, managers must account to the owners and society in general regarding the manner and results of their management. The donors require accountability so that they are sure money is used as intended. Then what is accounting? Somehow we are a bit repeating, but it's always good to remind ourselves. So accounting is the process of classifying, preparing, and analyzing financial statements based on transactions recorded through the bookkeeping process. The next one. Then also we have the role of the accountant. An accountant prepares three key financial statements, which are a balance sheet, income statement, and cash flow statement. I believe that in the next session, we shall talk a bit also about this, the balance sheet, how it looks like, and then how to incorporate the income statement and cash flow statement. Next one. Yeah. So why do we need financial reports? First is to assess the stewardship and accountability of the management. Then to assess the ability of the organization to sustain its operations, to assess the security of funds loaned to the organization, and to regulate activities of the organization. Then still on the need for financial reports is to assess whether funding requirements are adhered to guide management in planning and decision making, to assess financial stability of the organization, and to assess whether organizational objectives are being met. And then to ensure adherence to legal requirements, filing of annual returns, like for example, like ourselves, every year we submit to SARS, what has been our financial year. And then who are the users of these financial reports? Church members, like bishops or cardinals, the stakeholders, investors, senior management, those in charge of the places, employees, unions, lenders and creditors, existing and potential customers, donors, government, and regulatory agencies. Still, then the users of financial reports are normally directed to a wide range of users who include the investors. They need information, then how to decide on whether to buy, hold, or sell their investments, and to assess the ability of the organization to pay dividends. Also, two employees need to assess the stability and profitability of the employer. So then the work has to be done in a productive way so that the employer has funds to help the stability. Then the ability of the organization to provide retirement benefits and employment opportunities. So once some are retired, new ones may come in and take their places. And then to lenders to determine whether their loans and interest attached to them will be paid when due. And then to suppliers and other creditors, it requires information that enables them to determine whether amounts owed to them will be paid when due. So it keeps to have an account. Then why the project financial reports are necessary for project coordinators, because good project management calls for regular monitoring, evaluation, and hence reporting. Reports show areas that need change. So if you have the reports at hand, you see where you have to adjust, to update, to change. And reports show how a project is working, if it is working well, or if what are the limitations, where to pay more attention. The information assists in making decisions about the project's future funding requirements. So also to see where to invest and then where to look for funds. And then who are the potential investors and other users? So they to go the financial strength of the company, in earning potential, asset and capital base of the company, to see the potential risks in dealing in the company's shares, and management capacity of the company. So finally, accountability is fulfilled when resources are used efficiently and effectively as planned, and reports submitted to internal management and other interested parties at the specified times. So also it works on a regularity, can be monthly, quarterly, 6 months, a yearly. It depends how it is arranged. Then there is a generally accepted accounting principle, which is written as GAAP. So these are the common set of accounting principles, standards, and procedures that organizations use to compile their financial statements reports. So this is a kind of a common setup that organizes and understands the procedures of all the financial statements, so that everything works in common and not each one going in his own way. Then International Financial Reporting Standards, IFRS. These are globally accepted standards of preparing financial statements based on the accounting principles. Still on the International Financial Reporting Standards, countries, through their national accounting professions, are supposed to adopt the IFRS. In Kenya, when I took this course, it's the ECPAK issues accounting standards that are in conformity with IFRS. And countries through their national accounting professions are supposed to adopt the IFRS. In Kenya, the ICPAK issues accounting standards that are in conformity with IFRS. Next one. Then there are 3 depreciation methods, which are straight line method, reducing balance method, and revaluation method. Now this one I'm going to share a bit more with you on this coming session, because I went a bit through today, but I didn't have time to finalize. So I'll come back to it in our next session. Then we have 12 key accounting concepts. First is separate entity concept. So accounts are kept for entities and not to the people who own or run the company. Even in proprietorships and partnerships, the accounts for the business must be kept separate from those of the owners. So then Then there is the money measurement. For an accounting record to be made, it must be able to be expressed in monetary terms. For this reason, financial statements show only a limited picture of the business. Consider a situation where there is a labor strike pending or the business's owner health is failing. This information is not reflected in the financial statements. Now I have something that I added here. Okay, for the first point, I forgot. It states that that we should always separate records, the transactions of a business and its owners. So there's a separation. And then an owner cannot remove funds from a business without recording it as either a loan or compensation or an equation distribution. Otherwise, the owner may buy something and leave it to the books on the books of the business, when in fact the owner is treating it as a personal possession. Still on the first point, an owner cannot extend funds to a business without recording it as either a loan or a stock purchase. And the separate entity concept is useful in case there is a legal judgment against the business, since the owner does not want to have personal assets intermingled with those of a business and therefore subject to forfeiture. In addition, the separate entity concept is useful for determining the true profitability and the financial position of a business. So it is, of course, even for legal reasons, it is good that there's a separation of duties and of responsibilities. Also for so if I have someone has to answer before the other, so there is a clear distinction on this aspect of responsibilities and demands. And then on the second, money and measurement. So it's something to add to that information and maybe to clarify. So money measurements, it states that a business should only record an accounting transaction if it can be expressed in terms of money. This means that the focus of accounting transaction is on a quantitative information rather than on qualitative information. Then they have some examples that cannot be recorded as accounting transactions because they cannot be expressed in terms of money, which are the employee skill level, employee working conditions, expected resale value of a patent, value of an in-house brand, product durability, the quality of customer support and field service, the efficiency of administrative process. Okay, I may pass to number 3. You may move, Sita, to number 3. Yes. Then going concern, accounting assumes that an ORG will continue to operate indefinitely. This concept implies that financial statements do not represent a company's worth if its assets were to be liquidated, but rather that the assets will be used in future operations. This concept also allows business to separate, amortize the cost of an asset over its expected useful life. So by making this assumption, the accountant is justified in deferring the recognition of certain expenses until later period, when the entity will presumably still be in business and using its assets in the most effective manner possible. Number 4. Then we have the cost. An asset is something that is owned by the company, is entered into the accounting records at the price paid to acquire it. Because the worth of an asset changes over time, it would be impossible to accurately record the market value for these assets of company. And on this is say that, no, not this one. Yeah. So for example, if you buy like a printer or a computer, because you buy it at a certain price, and then with the time, the value changes. So that's why you cannot assess it, as I said, cannot given the same price cannot be the same today and the same a few years, but they have to work on the market value, yeah, after some time. Then we have this dual aspect double entry. So this concept is the basis of the fundamental accounting equation. So assets is equal to liabilities plus equity capital. Now, when we finish this, the slides, the presentation, I will come back to this example, to this point with some examples that we understand this one. We'll move to number 6, please. Or then it a bit it explains what are assets, liabilities, and equity. So assets are what the company owns. Liabilities are what the company owes to creditors against those assets. Equity is the difference between the two and represents what the company owes to its investors, owners. All accounting transactions must keep this equation balanced. So when there is an increase on one side, there must be an equal increase on the other side. Okay. Then the objectivity. The objectivity concept states that accounting will be recorded on the basis of objective evidence. So invoices, receipts, bank statements, etc. This means that accounting records will initiate from a source document, and that the information recorded is based on fact and not on personal opinion. Yeah, so I cannot justify something that maybe I don't have an invoice or a receipt. So I cannot say that I spent something or I bought and then I don't have the evidence. Then the time period, this concept defines a specific interval of time for which an organization's reports are prepared. This can be a fiscal year from July. This is in Kenya. I think is from 1st of April to 31st of March, at least for us. The Diocese of Witbank was like this. Then or any other meaningful period could be. Then we have internally, for example, like ourselves, the companies, even the Diocese of Witbank, we have a quarterly report. So we have 4 quarter reports in a year, and then at the end of the year we have the annual report. Now we have this conservatism point. This requires understanding rather than overstating revenue, income, and overstating expense amounts that have a degree of uncertainty. The rule is to recognize revenue when it is reasonably certain and recognize expenses as soon as they are reasonably possible. And it says also that the conservatism accounting is a set of guidelines in bookkeeping. Following the conservative approach, companies can only claim profit when it is fully realized and legally verified. And a company should factor in the potential worst case scenario when making financial forecasts under these guidelines. For example, if there are 2 opinions to choose from, the accountant should choose the one with lower numbers to stay on the safe side, while uncertain liabilities would be recorded upon discovery. Revenues can only be recorded upon assurance of receipt. Then move to number 9, and then the realization. So revenues are recognized when they are earned or realized. Realization is assumed to occur when the seller receives cash or a claim to cash, receivable, debtor, in change for goods or services. Now can move to number 10. Then matching. To avoid overstatement of income in any one period, the matching principle requires that revenues and related expenses be recorded in the same accounting period. So you cannot just record income and then ignore expenses. So if both of them are there, so they should be registered. Just hold on, let me open. And then still on the matching, I have something also I got. So the matching principle is an accounting concept that dictates that companies report expenses at the same time as the revenues they are related to. And revenues and expenses are matched on the income statement for a period of time, which can be monthly, quarterly, or yearly. Okay. You can move to number 11. Then on consistency, once an organization decides on one method of reporting, method of accounting for inventory, it must use the same method for all subsequent events. So in accounting, consistency requires that the company's financial statements follow the same accounting principles, methods, practice, and procedures from one accounting period to the next. This allows the readers of the financial statements to make meaningful comparisons between years. So if there's a bit of a change, then it becomes more difficult to read and understand statement to compare. Number 12. Materiality. An item is material when its inclusion or exclusion in the financial statements would change the decision of a statement user. All material items should be disclosed in the financial reports, while immaterial ones may be considered. So the materiality concept or principle is an accounting rule that dictates any transactions or items that significantly impact the financial statements. Then by understanding and applying these principles, you will be able to read, prepare, and compare financial statements with clarity and accuracy. So this is an ongoing process, so that, yeah. Okay. So what appears in the balance sheet that I hope to share a bit more with you the next session. So an asset is the property owned and controlled by an organization whose future economic benefits is the potential to contribute to the cash inflow of an enterprise. Okay, next. Then liabilities. A liability is the obligation to pay. It is a present obligation of the organization arising from past events, the settlement of which is expected to result in an outflow of resources from the enterprise. So the balance sheet contains the property, plant, equipment, vehicles, the investments in subsidiaries, investments in associates, intangible assets, trade debtors and other receivables, trade creditors and other payables, equity capital, stocks, cash and cash equivalents. Next one. And then the income statement, we have the income. This comprises of revenues and gains. Revenues also refer to sales, fees, donations, tithes and offerings, interest, dividends, royalties, rent, income, etc. Revenue arises from the ordinary activities of an enterprise. Next one. Also on the income statement, the income and expenditure account is different from the cash book and the receipts and payments, since no cash items are also included. Example, depreciation and accruals. Okay. Then with the income statement, that also the depreciation may be calculated using 3 methods. The straight line method, the reducing balance method, and revaluation method. So the ones that I'm going to share with you next session. If sales have been made on credit, these are included together with cash sales, but advance receipts or deposits are excluded from income statements. Next one, the on cash flow statement. This shows the resources and application of funds. It is the link between BS and ICS. No, I don't. Then sources include from
the balance sheet said in income.
Okay. Then sources include from operations, disposals of assets, loans, issue of shares. Application of funds include payments of dividends, purchase of assets, payment of interest, etc. Next one, please. Yes. And then financial information. In order to ensure profitable use of information available in financial reports, it is recommended that the report should be reliable, relevant, and easily understood, and provide adequate disclosure. This shows the sources of application of funds. Oh.
Where are we? Okay, this one, yeah.
Yeah. So in order to ensure, okay, so reports are made available to readers on time, so time and timeless. Otherwise, the information loses its relevance. So if you prepare it and give it in 6 months, so it is already past information. So something have already happened in between. Okay, I think, yeah, then I think the narrative comes for the next session. Next.
Okay.
So then I'm going to share with you on the. Let me. Okay, so I want to share with you this dual aspect double entry. So we went already through what are the assets, what are liabilities, what is equity. So the formula is to know the assets is equal liabilities plus capital or equity. So liabilities and equity are listed on the right side or bottom of a balance sheet. Below is a simple example of balance sheet. Since there's only one liability, accounts payable, there's only one category, current liabilities.
Sorry, Brother Paulo, are you sharing? Oh,
Yeah, it's not appearing there.
No, we haven't
Oh
seen.
my.
You have to put
sorry.
it on the screen, yeah.
Okay. Because
All right, now it's fine. Yeah.
Okay.
No.
Okay.
Okay.
It's okay now? Okay.
No,
Sorry.
yeah, okay.
No, because it didn't push. Okay. So then this is the balance sheet of March 3, 2023. So yeah, that is current assets. So the accounts receivable were of 18,724.26. So it appears under total current assets of 18,724.26. So the total assets of 18,724.26. Now on liabilities plus equities, we have the accounts payable of 9,018 rands and plus retained earnings of 9,706 rands 26 cents. So when so we said that assets is equal to liabilities plus equity. So so this the assets is the liabilities or yeah. So it is 9,018 rands plus 9,706 rands. So it comes to 18,724 rands 26 cents. So you see assets is 9,018 rands plus 9,706 rands 26 cents. Assets equal 18,724 rands 26 cents. So this is a simple equation where just to show how the assets work. So liabilities plus equity. And then okay, after when I'm going to provide you the the proper sheets separate so that also our students, that's put in between brackets, will be able to follow it in a better way. Now, let me see if I'm able to share now. 3. So now I wanted to go back a bit to the example of a bank. So let me see. I'm not able. Let me see if I'm able to. No. Okay, I would like to share with you, but maybe something is missing here. It didn't copy. Okay. So in online bank statement, there was an amount of 103 rands, 26 cents, 9 cents, and there was online banking because now we in South Africa we don't work anymore with checks, so now we work with the bank statements, and most of us with the online bank statements.
Brother Paulo, it's not on the screen. You have to put it up.
Okay, so let me and now?
Not yet.
It's not showing. Okay. So on the 6th of July, so the online banking was showing 103 rands, 103,000 rands, 26.
No,
While
seen it on the screen. We have to share.
why is it not?
Okay, now it's better. Yeah.
Okay. It's complicated today. Okay. So I got an example. This is a true example of Maria Trost. So I'm not just is it not fictitious. So on 6th July, if you remember, there was an online bank statement of 103,000 rands, 26 rands, and a few cents. And online banking was 108,329 rands and 56 cents. So it shows that okay, the bank statement is correct because it shows the transaction between what was paid immediately to the receiver, but the online banking only shows what we paid a few days later. So that's why, for example, if we only show to we only look at the online banking, we think that we have lots of money in the bank account, when in reality the bank statement shows otherwise. So in order to get the bank reconciliation done, you have to go to the online banking and deduct the transaction that happened between the 4th to the 5th of July. So the citizens went to Superspar, they went to the butchery, they went to Obaro and NM Trading and ShopRite, and so they had these expenses. So it is, I think, it's 4,000 something rands in between. The difference should be the number. So then, when you deduct these amounts from the 108,329.56, it comes to 103,026.09. So this is how it works. I would like to have shown you the for some reason I'm not able to share it with you. Now I have another one. I don't know if you're able to see this one, sister.
Yeah. Yes.
Okay. Now this one. Okay, what I'm yet trying to explain a bit. Okay, this is now what happened between the 7th of July to the 14th of July. Okay, because so the sisters continue doing their shopping, and also some incomes took place. So to understand that from the 7th to the 14th, these were the incomes. So Police Council 32,400, other deposits. Okay, then total deposits, it is a sum. Then from a parish 6,000, Another from Priest Council, maybe another invoice was paid 3,150. Walter Server's workshop 11,600. So it comes to 53,150 runs. And on the 8th July, there was an income of investment interest from another account of 131 runs 10 cents. And in this time, there were deductions of a monthly account fee. So the service was paid to the bank for the using or transferring of money. And then there were the directed or deduct debits or from the different places where the sisters went shopping. So this to understand that in the so that the bank statement or the online bank statement, the movements or transactions are made out of deposits or the payments of deductions, being it from the bank account fees or deductions from direct debits. So then, okay, then there was another debit. They went for some, so for the optician and another shop might do something. So then on the 14th July, the bank statement contains an ending balance of 148,949 rands 44 cents, where the sisters online banking shows a balance of 153,362. Okay. So first you start with your closing balance of the bank statement and see where it stands, and then you add, okay, if you have anything to add like deposits, you add to it, and then you add earned interests and or add deduct fees or penalties that may have occurred in between. So so then, okay, on the 14th, so this was the amount shown on the bank statement, yeah, the 148,000, and on the online banking 153. So then now the sisters had an expense of 4,413. So when you deduct this 4,413 from the 153,000, it comes to 148,949 rands 44 cents. So I hope that I was able to explain a bit. Okay, afterwards I'm going to share it with the sister so that she can provide you, so that you can go through and understand how it is done. Okay, this one is done. Now let me see. Then are you able to read this one, sister?
Not yet.
No, not yet. Okay. So then I need to.
Is it the Word document? Okay, yeah, it's coming now.
So this a bit to because last week we mentioned a bit about some of the bank accounts. So I have just a few explanation of these current accounts, what they are. So what is a current account? So a current account is a type of bank account that most people use for day-to-day purpose. And so it allows people to have a secure place to receive their salary and other payments from. A current account is typically comes with a debit card, which is helpful when paying items or entering cash. So they are called current as the funds they hold are typically used currently. For instance, a conventional monthly cycle of receiving a wage and spending money. A current account is the central pillar trying to bring together someone's personal finances. So what is a current used for? A current account can be used for a variety of things, and ultimately it depends on the holder. Some of the most common uses for a current accounts are so receiving your salary, online shopping, paying bills, subscriptions, everyday spending, and direct debits. Many types of current accounts do not come with a monthly fee, However, a current account can come with fees for particular situations and features. They might include fees for using an overdraft, sending money abroad, and accessing rewards. I will say what is the difference between a current account and a bank account. A current account is the specific term for this type of account. And while bank tends to use the specific term so as not to confuse them with other account types. Then also a savings account is also a bank account, but is different from a current account. The current account includes, of course, debit cards, arranged overdraft service, online banking and mobile app, ability to use Apple Pay and Google Pay. Another one. Then you have a Then you have a fixed deposit. Fixed deposits are safe investments that allow you to earn regularly interest income. Then its takeaways. A fixed deposit is a safe investment through which you can earn interest income. Fixed deposits promise guaranteed returns and involve no risk of loss of principal amount. Returns on fixed deposits are unaffected by market fluctuations. All interest gains from fixed deposits are taxable by law. You can avail of top-up loans against your fixed deposit. Fixed deposit is an investment plan wherein you can deposit your lump sum of money for a fixed period and earn interest. The rate of interest associated with fixed deposits depend on the principal amount invested and investment tenure. Let us see. Then you have also the saving account. A saving account is an interest-bearing deposit account held at the bank for financial institution, though these accounts typically pay only a modest interest. Their safety and reliability make them good option for parking cash that you may have available for short-term needs. Saving accounts may have some limitations on how often you can withdraw future, but generally offer exceptional flexibility that's ideal for building and emergencies. Now it is eating my text here. Okay, then the key takeaways, because saving accounts pay interest while keeping your funds easily accessible, they are a good option for emergency and short-term cash. In exchange for the ease and liquidity that saving accounts offer, you will earn a lower rate than that paid by more restrictive saving instruments and investments. The amount you can withdraw from a saving account is generally unlimited. And the interest you earn on a saving account is considered taxable income. How does it work? So savings and other deposits accounts are important sources of funds that financial institutions use for loans. Saving accounts can be found at virtually every bank on credit union. Saving accounts interest rate vary. Money can be transferred in and out of savings account online at a branch or ATM, and electronic transfer or direct deposit. Yeah. Maybe there are too many things to share. Okay, then also just the money on call. Money on call is any type of short-term interest earning financial loan that the owner borrows and has to pay back immediately when the lender demands. The key takeaways: money at call is any type of short-term interest earning financial loan that the borrower has to pay back immediately when the lender demands. Money at call gives banks a way to earn interest, known as as the call loan rate, while retaining liquidity, and after cash, it is the most liquid asset on their balance sheet. Aside from generating interest, money at call goes to true value is in providing banks the opportunity to profit from surplus funds and maintain proper liquidity levels. So money on call, also known as call money or at call money, is any financial loan that payable immediately and in full when the lender, usually a bank, demands it. Typically, it is a short-term interest paying loan from 1 to 14 days made by the financial institution to another financial institution. Due to the short-term nature of the loan, it does not typically feature regular principal and interest payments, which longer-term loans might. Money at call differs from short notice money, which is similar but does not require immediate payment when called. Rather, there is a time range of up to 14 days that the lender has to pay back the loan. No, not this. Okay, just maybe 2 things, and afterwards I share that others that next time. Then there's also the online banking. Online banking allows you to conduct financial transactions via internet. It is also known as internet banking or web banking. It offers customers almost every service traditionally available through a local, including deposits, transfers, and online bills payment. Virtually every banking institution has some form of online banking. You can through computer or app. With online banking, you are not required to visit the bank, so they don't want the customers to go anymore there, so they make this means of accessing to money without disturbing them. In other words, just this one. And then, okay, then what we mentioned last session, the bank charges. So to what are bank charges or bank fees? Bank fees are charges levied by financial institutions to various services and transactions. So it covers all charges and fees made by a bank to their customers. It often relates to personal current accounts or checking accounts. Types of bank fees. There's a service fees. Service fees can be applied to checking or saving accounts, and essentially you get charged for keeping the account open. You are giving the bank money just for your name and deposit amount in its computer system. There's also the maintenance fees. Maintenance fees are some of the sneakiest ones out there. Service fees can be applied to checking or saving accounts, and essentially you get charged for keeping the account open. These fees are usually charged or deducted from your balance at the beginning or month end. The transaction fees, certain types of transactions are riskier for banks than others, or they require more effort from the bank. So wire transfer fees, when you send someone money, the bank is basically acting as a courier servicer. to make sure the money gets there. Then international transaction fees when you get money from abroad or you send. You may also have to pay foreign transaction fees if you use your debit card or buy certain products while you are visiting another country. And then also we have the ATM fees. Maybe I think some of us are not aware of it. So when you use an ATM that doesn't belong to your bank's network, for example, if I'm working with NB, if I go to Standard, so they will charge me for depositing or getting money from from there. What are the legit reasons for some of the ATM's fees? So network processing costs, risk of fraud coverage, physical rents of the ATM's location, and security services to stock and transfer money. There's also the debit card definition. A debit card is a payment card that deducts money directly from your checking account that are used to buy goods or services or to get cash from ATM. Debit cards can help you reduce the need to carry cash. And nowadays, because also of the security, people come to steal from you. Although using these cards can sometimes entail fees. So how does it work? It is linked to a checking account, and it looks like a credit card, but it works differently. The amount of money you can spend on a debit card is determined by the amount of funds in your account, not by a credit limit such as credit cards carry. Okay, that's some of the information. No, I have more, but maybe the time is not gone. Yeah. Yeah. I think some of it after information I will share with you, because you can read at home and go through it.
Thanks so much, brother. Yes, we will share all this information and also the presentation to you,
yes,
and recording as well. Thanks so much for joining us today. I think we have reached our time. Just to say the Thanksgiving prayer, and then we'll sign off. Thanks once again, everyone. And the next workshop will be, I think, next month, I think in August.
15th of August, yes.
Okay. And on the 15th of August. So we hope to see you again. So let's really give thanks to God for all the blessings and for everything that He provides for us as we sign off and continue on our journey. We ask the Lord to continue to bless us as we pray in the name of the Father, Son, Holy Spirit. Amen. O gracious God, who so generously lavished our lives with goodness, create in our hearts a deep center of gratitude, a center that grows so strong in its thanksgiving, that sharing freely of what we hold dear becomes the norm and the pattern of our existence. Remind us of often how much you cherish us, how abundantly you have showered us with your blessing, especially in the hour of our greatest needs. May we always be grateful to your reaching into our lives with surprises of joy, growth, and unearned love. We are grateful for the eyes of faith, for believing in the presence of God, giving us hope in our darkest days, encouraging us to listen to our spirit's hunger, and remind us to trust in the providence and presence of God in our most empty days. We are grateful for the gift of loved ones whose love, openness, and acceptance have encouraged us to be who we are. We are grateful for their faithfulness, for standing by us when our weaknesses stood out glaringly, for being there when we were most in need, and for delighting with us in our good days and our joyful seasons. We are grateful for your messengers, peoples, events, written or spoken words that came to us at just the right time and helped us to grow. We are grateful that we have the basic necessities of life, that we have the means and the ability to hear the cries of the poor and to respond to with abundance. We ask you to bless us and bless us kindly. Amen. In the name of the Father, and of the Son, and of the Holy Spirit. Amen. Thanks so much, everyone, and God bless and keep warm. Thanks a lot. God bless. Okay, bye-bye.